Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, what if the biggest misunderstanding in crypto isn't about Bitcoin? Not about Ethereum, but about XRP. Because while most investors are arguing about charts, candles, and market caps, something much bigger may be unfolding beneath the surface. New legislation, institutional infrastructure, global payment modernization, regulatory shifts, and a financial system searching for faster ways to move trillions of dollars around the world. The question isn't whether XRP can move. The question is whether most people are looking at the wrong metrics entirely. And if they are, the implications could be enormous. Mention a 3-digit XRP price target almost anywhere online, and you'll hear the same response. Impossible. The market cap would be too large. It can never happen. Blah, 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 blah. For years, that's been the default rebuttal. And on the surface, it sounds logical. If XRP were to reach $100, $200, or even $300, critics argue that its total valuation will become so massive that it would exceed what they consider realistic for a digital asset. Case closed. Except that's where the debate becomes interesting, because supporters of XRP, the anointed one, argue that this criticism starts from a flawed assumption. They're treating XRP like a stock, and XRP was never designed to function like a stock. Stocks represent ownership. XRP was built as a bridge asset, a liquidity tool, a settlement mechanism. Write this down. It's very important. People miss this. Something designed to move value from one place to another. That distinction matters because when a bank uses a settlement network, the objective is not necessarily to accumulate the asset forever. The objective is efficiency. The objective is movement. The objective is liquidity. And that changes how some analysts think about valuation. Now, whether those analysts are ultimately correct remains to be seen. But here's where it gets interesting. The debate may not be about speculation at all. It may be about infrastructure, and infrastructure often becomes valuable for entirely different reasons than people expect. History gives us a fascinating example. In the 19th century, the construction of the Transcontinental Railroad fundamentally changed commerce across the United States. Before rail networks connected the country, moving goods was slow, expensive, and inefficient. Afterward, entire industries transformed. The railroad itself became part of the economic system, not because people were speculating on trains, but because commerce increasingly depended on the rails. That's historical example number one. The reason it matters today is simple. Financial systems are infrastructure too. Payments are infrastructure. Settlement systems are infrastructure. And whenever infrastructure evolves, enormous amounts of value can shift alongside it. Now, this is what most people miss. Many crypto discussions focus almost exclusively on price. Institutions focus on utility. Let that sink in. Write that down. They ask different questions. Can it scale? Can it settle transactions? Can it reduce costs? Can it improve liquidity? Can it fit inside regulatory frameworks? Those are the questions that determine whether infrastructure survives. And they're increasingly relevant as global finance becomes more digital, ladies and gentlemen. According to data frequently cited from international financial institutions, global foreign exchange activity reaches extraordinary volumes every day. We're talking trillions of dollars moving across borders every single day. Think about that for a moment. Not billions, trillions. These transactions often rely on systems developed decades ago. Pre-funded accounts, correspondent banking, relationships, layers of intermediaries, complex settlement procedures. The system works, but many argue it isn't optimized. This is where XRP supporters build their thesis. They argue that if even a small percentage of global cross-border settlement eventually utilizes blockchain-based liquidity solutions, demand for efficient settlement assets could increase significantly. Notice the key phrases there. Could, not will, could, because adoption is never guaranteed. But the possibility is what attracts institutional attention. The conversation becomes less about speculative trading and more about payment efficiency, less about retail enthusiasm and more about financial plumbing. Financial plumbing tends to be invisible until it suddenly becomes essential. One of the most discussed concepts within the XRP community is liquidity. The argument is straightforward. If a settlement asset is expected to facilitate large transaction volumes, sufficient liquidity is required. Without liquidity, slippage increases, costs rise, efficiency falls. Supporters therefore argue that higher transaction volumes would require a higher asset valuation to support larger value transfers efficiently. Let that sink in, write that down. This idea is often referred to as liquidity mathematics. Whether the exact conclusions are correct remains heavily debated, but the underlying principle is easy to understand. A system expected to move large amounts of value must possess sufficient depth. Think of it like a highway. A narrow road may handle local traffic. A major international trade route requires far greater capacity. The same logic is frequently applied to financial networks. And that's why some analysts arrive at price targets that appear shocking to casual observers. Not because they're predicting retail speculation, but because they're modeling potential infrastructure demand. And again, the timeline remains uncertain, but the framework itself is very different from traditional crypto speculation. Price tells one story, ladies and gentlemen. Behavior tells another. Many analysts closely watch on-chain metrics because they reveal how investors are behaving beneath the surface. Ladies and gentlemen, price tells one story. Behavior tells another. Many analysts closely watch on-chain metrics because they reveal how investors are behaving beneath the surface. When large numbers of participants are underwater on their positions, markets often enter periods of capitulation. Weak hands exit. Strong conviction holders remain. Historically, some of the most powerful rallies across financial markets have emerged after periods of maximum pessimism. Not because conditions look good, but because expectations have become extremely low. This isn't unique to crypto. It's a recurring pattern in market psychology. Fear creates opportunity. Euphoria creates risk. And while no indicator predicts the future with certainty, investors continue monitoring these metrics for signs that sentiment may be shifting. But here's where it gets interesting. Price recovery rarely begins when everyone feels optimistic. It often begins when almost nobody does. If there's one factor institutions consistently prioritize, it's regulatory clarity. Not hype, not social media trends, clarity. Large financial organizations operate under strict compliance requirements. Before allocating significant capital, they want legal certainty. They want defined rules. They want predictable oversight, ladies and gentlemen. This is so important. For years, uncertainty has acted as a major obstacle for broader digital asset adoption. Not necessarily because institutions lacked interest, but because unclear regulations create risk. This is why every major legislative development receives so much attention. Whenever lawmakers discuss market structure frameworks, commodity classifications, stablecoin regulation, or digital asset oversight, institutional investors pay attention because regulatory clarity changes behavior. Capital that remains on sidelines today may become deployable tomorrow. And that's where XRP supporters believe a potential catalyst exists. If regulatory uncertainty continues decreasing, institutional participation across the digital asset industry could expand dramatically, not just for XRP, for the entire sector. Short-term noise, long-term structure. That's the distinction investors are watching. History repeats itself often, ladies and gentlemen. Consider another historical example. In 1971, the United States ended the Bretton Woods monetary system. That's historical example number 2. The shift fundamentally changed how currencies interact globally. Financial markets had to adapt. Institutions had to adapt. Governments had to adapt. Entire frameworks evolved. The transition wasn't immediate. It unfolded over years, but eventually a new financial structure emerged. Today, digital assets transformation may not be identical, but it reminds us of something important. Major financial transitions rarely happen overnight. They happen gradually, then suddenly. Most people only notice after the infrastructure is already in place. The institutional build-out. Ladies and gentlemen, one reason XRP remains a subject of debate is that its supporters point to infrastructure rather than narratives. They highlight payment partnerships, settlement technology, financial integrations, institutional connectivity, and increasingly stable coin ecosystems. Whether every initiative succeeds remains uncertain, but institutions typically evaluate implementation rather than marketing. Can it function? Can it integrate? Can it scale? Can it comply? Those questions matter for more than social media popularity. Prices reacting, systems evolving, and sometimes the system evolves long before price catches up. That's why many investors are attempting to identify today the difference between temporary market fluctuations and structural financial change. 2 historical analogies. Think of today's financial system like a medieval trade network. Merchants could move goods across continents, but every border introduced delays, costs, and friction. Digital settlement networks aim to reduce those frictions, much like standardized trade routes, eventually streamline commerce. That's historical analogy number one. Here's another. Imagine the early internet. Most people focused on websites. A small group focused on protocols. The websites attracted attention. The protocols carried the value. That's historical analogy number two. In the same way, investors today often focus on tokens. Institutions may be focusing on infrastructure. The distinction could prove important. So can XRP reach 100, 200, even 300? Nobody knows. Anyone claiming certainty is overstating their confidence. But what we can say is this. The debate is no longer simply about price. It's about infrastructure. It's about liquidity. It's about regulation. It's about the modernization of global financial systems. And perhaps most importantly, it's about whether digital assets become integrated into the architecture of international finance. Because if that happens, the winners may not be determined solely by speculation. They may be determined by utility, adoption, and institutional demand, by real-world implementation, short-term noise, long-term structure. That's the story investors are trying to understand. And the next few years may reveal whether XRP becomes one of the most important pieces of that story. If you enjoyed this breakdown, let me know in the comments, subscribe, and join the Wolfpack. Hit the notification bell and share your own XRP price targets in the comments below. Do you believe three-digit XRP is possible? Or do you think the market is still getting ahead of itself? Let us know. As always, you got to do your own research. This is not financial advice. Never invest based solely on a YouTube video. Remember, short-term noise, long-term structure. Pay attention to what's quiet, I always say. Don't get caught up like sushi. I'll see you in the next video. Happy Monday, everybody. Sorry I haven't been here for a couple days. I was visiting with clients. If everyone's paying attention to what's going on since the last video, what we went over in copper is beautifully played out. But before we go any further, I want to give a big shout out to Everly. Listening to your mother and father, you will never get caught up like sushi. A major, major fan of the channel. Big shout out to Everly. Never, ever, ever get caught up by sushi. Always, always listen to your mother and father. You'll never have better friends than your mother and father. If you look at the markets, they tell a story. It's the narrative that I've been going over and harping on these videos. Death by 1,000 headlines. Death by 1,000 tweets. Blah, 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 blah. That is how the sushi becomes fresh. As financial mercenaries, we take advantage of the chaos. As the remoras, we feast on the sushi. Ladies and gentlemen, if you made it to this point in the video, these videos are free. You see how we find the opportunities. Inside of our Patreon, the Crypto Republic Desk Monthly, you get to see how and why we act on them. When you're ready, come and join and take advantage of our highest conviction ideas. One tip from the pits can pay for your entire year's subscription. Join over 565 active traders and investors who have decided to take advantage of this time period by learning how to capitalize off of the chaos in the markets and become a financial mercenary. Welcome to all the new members of the Crypto Republic Desk Monthly and all the new members of the membership channel. And of course, Everly, our favorite fan. Have no emotions in the markets. None. That's why being a financial mercenary is not about any form of emotions in trading. It's about discipline and doing the same thing over and over and over again. If you can do the same thing over and over again, you learn that you are taking a lot of small wins. You are not looking to hitting it out of the park every day. You're not looking to do that. You'll hit base hit after base hit after base hit, and you keep winning that way. Bitcoin has officially confirmed the structural breakdown. We haven't seen something like this since June 2022. We're out of our Bitcoin longs. When we have said this on the videos time and time again, we're looking at a classic bear flag pattern right now, and that's probably going to accelerate to the downside. But again, ladies and gentlemen, you learn to have financial discipline as a financial mercenary. You're rewarded for your cold-hearted calculations. You're never going to get out the high. You're never going to buy at the low. You're going to learn to play the mundane, boring, obvious over and over again. That is how you get ahead with this, as far as we're concerned, again. But what that has for the broader market, people sell in May, they go away. They're not going to do anything during the summer. And with the headlines of a soft kinetic fighting still going on. That tells another story as well, ladies and gentlemen. So you could be prepared for a lot of financial chaos. None of this is financial advice. It's just my opinion. Anyone has any capacity. But going back to what I said about copper, that was very, very important. But before I get to that, the U.S. Federal Reserve Governor Christopher Waller stated that global adoption of stablecoins could expand the influence of U.S. monetary policy. Waller supported stablecoins for propagating the U.S. dollar, but emphasized the need for regulation, while criticizing central bank digital currencies as unnecessary. This is also very important. JP Morgan Chase CEO Jamie Dimon warned that the latest Clarity Act draft could fail unless concerns from traditional bank accounts, stablecoins regulations are addressed. Dimon urged stablecoin issuers could pay deposits like yields without bank safeguards. The legislation progress has been stalled by this dispute. Ladies and gentlemen, according to Citibank, they project tokenized securities could reach $5.5 trillion by 2030, fueled by mainstream adoption, increased stablecoin use, and regulatory clarity. The report explains you're seeing the full weight of American financial power and the global reserve currency moving on scale at scale. When DTCC and the New York Stock Exchange embedded tokenization into capital markets, this marks a tipping point. These are the biggest things that we're paying attention to right now, right? But it's like I've been telling everybody here. The reason most people miss these shifts is because they wait for some form of consensus. But by that time, the consensus arrives. Ladies and gentlemen, institutions already positioned supply chains ahead, and they already repriced margins, already compressed inflation, already transmitted downstream. This is why understanding macroeconomies is such an unfair advantage. It really, really is. They tell you what the real economy is doing before economists admit it. Why I keep telling you this, and this is why if you make it to these parts of the video, you're learning so much, because we're telling you how to capitalize what we do, not financial advice, just my own opinions. And anyone has any capacity. We were talking about a copper, the last video, ladies and gentlemen. Copper is not just a metal. Copper is a lie detector for the industrial civilization, ladies and gentlemen. And right now, it's telling us demand is structurally stronger than the supply system can handle. If you looked at what it's done since the last video that we put out, unbelievable. Everybody's talking about it right now. See, when you pay attention to what's quiet, what's boring, that's where the greatest alpha is. That's why being a financial mercenary, you learn to take advantage of this, not when people are talking about it. See, when people start talking about things, that's when we're getting ready to exit. They become our exit liquidity. That's the FOMO. That's the market psychology of this game. That's the greatest lesson I learned on the Fulton New York Mercantile Exchange. If you look at what's happening and why, it tells a story. Ladies and gentlemen, this is also why serious analysis requires more than headlines. You have to track warehouse flows, speculative positioning, refining spreads, treatment charges, import data, smelter behavior, ETF positioning, trade policy, scrap retention, production disruptions. That's how professionals build conviction before price moves becomes obvious. That's what we do with every metal. That is how and why you make it to these parts in the videos to understand. This is what gives you the edge. Having that edge is what allows you to not get caught up like sushi, because most people only see the chart after the move. Institutional analysis sees the pressure building underneath the chart months in advance. And that difference changes everything, ladies and gentlemen. I want you to understand something. We're entering a world where commodity scarcity is becoming geopolitical power, energy security, grid security, manufacturing security, AI infrastructure dominance. All of it comes back to physical resources. I drill this into every video. And the scary part, the world spent the last decade pretending software alone runs civilization. It doesn't. Ladies and gentlemen, civilization still runs on mined materials. And when those materials tighten, everything changes. Our group has been taking things out of the ground for the last 20 years in some of the most austere regions on the planet. I learned a lot from natural resource concession development, mining and refining. I learned patience. I mean, I got crazy ADD, ADHD, everybody does. I learned patience. That was one of the big reasons why I was sent to the Fulton New York Mercantile Exchange at 15 years old. It was the only thing that could captivate my mind. If you listen to the second halves of our videos and you're here, you have such an edge in the market because you're hearing things before the market plays it out. All you need to do is go back to the video before this and listen to what we said about copper and palladium, and you would have been ahead for what happened in the copper markets. Maybe there'll be export tariffs. Who knows what's going to happen? All I can tell you is that the commodities is a theater of warfare today. I've been telling you about shortages. The war in the Middle East has not changed. It has not ended. It's about shortages, and there's going to be shortages, unfortunately, coming. When you see copper making new highs while palladium rolls over, you're not just watching two commodities move. You're watching the old economy hand the baton to the new one. You are watching electrification collide with resource scarcity. You're watching the next inflation regime quietly form underneath the surface. And most people won't notice until the consensus hits consumer prices, industrial margins, and financial markets all at once. But by then, ladies and gentlemen, the smart money will already be gone. So this is what we're paying attention to. The copper markets are entering a severe structural supply deficit. According to UBS, they project a 520,000 metric ton copper deficit by 2026. Copper demand is being driven by EVs, AI infrastructure, renewable energy, and grid modernization. Chilean production weakness and Chinese supply bottlenecks are tightening global inventories. Treatment and refining charges collapsing towards zero signals severe raw material scarcity. Write these things down. Palladium is shifting from deficit to surplus due to declining internal combustion engine demand. Commodity flows reveal macroeconomic shifts before mainstream financial media notices them. What I just said is so boring. It's like watching paint dry on the wall. But if you understand, you take one thing from this video, you write down what I just said, that is going to tell you everything you need to know. You could apply to be talking on TV after that. All you got to do is look at that ratio, those two movements every day, and then you can see the narrative play itself out. Physical inventory dynamics matter more than retail sentiment during structural transitions. I watch every day the Shanghai copper inventory drawdowns, the LME and COMEX warehouse positioning, China copper import data, U.S. copper tariff developments, scrap export restrictions, and retention behavior, smelter treatment refining charges, EV adoption rates globally, data center and grid infrastructure expansion, ETF positioning in palladium and industrial metals, Chile and Peru mining disruptions. Why this is important, ladies and gentlemen, because commodities are upstream of the entire economy. When copper tightens, infrastructure costs rise, energy transitions costs rise, manufacturing margins compress, inflation pressure increases, geopolitical competition intensifies. Copper is becoming a strategic asset tied directly to AI infrastructure, energy systems, electrification, industrial sovereignty, and the investors, operators, and analysts who understand these shifts early gain a massive informational advantage before the broader market catches up. Ladies and gentlemen, why I keep going over these things is this is why the world is changing right now. You know, when I first learned mining and refining on site in jungles, I didn't know what any of these things were. I had to learn on the fly, and I'm happy that the people who taught me were that smart to make me understand this. If you look at the world right now, there's not enough metals. There's not. This is where the world is going. Most people miss the main course. They get full on eating the appetizers. Don't get full eating the appetizers on the markets right here, right now. Don't do that. Understand that as the world changes, it stays the same. And what I mean by it changes, it stays the same. It changes because what's going to fuel profit changes, but it stays the same because you're still looking to try to get ahead and prosper from the changes. You're trying to invest. You're trying to get ahead. Not financial advice, just my own opinion and take any capacity. Look, who knows what can be said or done and what will really stick. The market is being moved by tweets. I have been saying this day in, day out for months. Death by 1,000 tweets or headlines. This is what this is. You learn to harness them and why. You pay attention to commodity markets that actually tell us where the world is going. Palladium is combustion engines. Write that down. So if palladium is doing one thing, you know what's happening with combustion engines. Copper does another thing. Write that down. If it's making all new time highs, like in this video we just said, tells you another thing. We started this channel to give back to everybody. You make a living by what you make, a life by what you give to other people. Because everyone in the retail and on Main Street should have access to what family offices have access to. That's what we feel and we believe. But teacher opens the door, student has to come in. Ladies and gentlemen, if you want to understand and prosper from everything I'm talking about, do come and join the Crypto Republic Desk monthly inside of our Patreon. One tip from the pits can pay for your entire year subscription. See how we actually take advantage of everything that I'm talking about here right now and why. And see how family offices accumulate alpha to build positions in physical plays that they want going forward. That's really what they're doing. Everybody had the big news about the DTCC. See, I like leaving this for the end of the video because I know the most hardcore supporters of the Wolfpack, and I love everybody. I love you all because we're all here together on the front lines and we're packing up. XRP is the anointed one. XRP will be in the DTCC in a better way than just being tokenized. It's actually in there being used for some of the ecosystem that Ripple purchased. The treasury system is more important than actually being utilized by the exchange itself. That's a big thing to understand. Ladies and gentlemen, now is the time to have the Gucci conviction, the Gucci clarity. Now is the time to dig deep, to realize why you're doing what you're doing. Because when Operation Print It to Win It begins, this time period would have passed. The most critical time right now are the months between today and after the election. It's what you do right now, not financial advice, just my own opinion, that's going to matter. See, as financial mercenaries, we look for the future. We look for the future because today's battle is over. The markets will close. Tomorrow's battle is just beginning. Understanding what the financial markets are telling us in different products is all that matters. What I went over about palladium and copper, what their highs and lows tell us and why. What ratios we look at and why. I love you all. I'll see you tomorrow. Always remember that this content is for information and entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves that it'll never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones who change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This has opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. I'll see you on the front lines.